Okay, so today we are doing a deep dive into something that really sits at the foundation of digital stability. We're talking about the biggest stablecoin in the world.
Titan, really.
Exactly. Tether, USDT.
Yeah.
And look, if you've ever thought their reserve structure was just, too dense to really worry about, well, a major credit rating agency just sent a message that you absolutely cannot ignore.
It's a huge deal for the market. We're talking about S&P Global, a name that basically sets the standard for financial risk, and they've issued a major downgrade for Tether.
Right. And our mission here isn't just to report that news. We want to get into the why. Why did S&P Global do this? What are the specific cracks they're seeing in the world's largest stablecoin?
And to really get a sense of the gravity here, you have to understand the scale we're talking about.
It's massive.
It is. Tether's USDT is the biggest stablecoin out there with, over $184 billion in circulation. This isn't some small project. It's systemically important to the whole crypto economy.
So when a coin that big gets a stability downgrade from a name like S&P,
it sends tremors everywhere. And their warning, it wasn't subtle at all.
No.
The core of it is that the changes in Tether's reserves, the assets backing the coin paired with these ongoing gaps in what they're telling the public, it's all enough to really undermine confidence, long-term confidence that it can hold that $1-to-$1 peg.
And that's the entire point of a stablecoin.
That is the whole game.
So let's get specific about what S&P did. They didn't just, tweak the rating a little bit.
Not at all.
They dropped Tether's stability rating to its weakest possible level.
Yeah.
And for anyone who doesn't live in the world of S&P ratings, that's a five-alarm fire.
It really is. Hitting that lowest possible assessment, it basically means S&P believes the whole stability mechanism could just completely fall apart under pressure.
Under adverse conditions, right?
Exactly.
Yeah.
It's a huge vote of no confidence in the underlying structure. And to understand why, you have to go back to the basic promise of USDT.
Which is pretty simple on the surface.
It's supposed to be simple. Maintain the dollar peg. And you do that with asset reserves that are super reliable, super liquid, and enough to cover every single USDT out there, even in a panic.
Right. And traditionally, that's meant things like cash and, short-term government debt, the safest stuff you can possibly own.
The things you know will be there tomorrow.
But the source material we looked at points to a huge shift here. And this is what really set off the alarm bells for S&P.
Mm-hmm.
So while Tether still holds most of its reserves in things like U.S. Treasury bills, they've been pretty actively shifting into other asset classes.
Other things that aren't traditionally seen as, stable in that same way.
And that seems to be the breaking point for the rating agency.
It is. If the whole point is stability, the assets backing it have to be beyond reproach. They have to be stable and liquid, full stop.
So when Tether started to diversify beyond that,
it just invited this kind of scrutiny. S&P is looking at this through a very, very conservative lens, the same one they'd use for a bank or a money market fund.
Okay, so let's really isolate it. What was the number one reason for the downgrade? What were the specific assets that S&P called out?
The primary reason they gave for that weakest rating was Tether's increased exposure to, and these are their words, volatile assets.
Volatile assets.
Yeah.
In a reserve that's supposed to guarantee stability.
It's a complete contradiction.
Right.
And they were very explicit. They named the assets that were raising red flags: Bitcoin and gold.
Wow.
Now, Tether is using these as part of its reserves. It's still a minority of the total backing, but just the presence of them and the fact that the allocation is growing, that's what triggered the downgrade.
Because from S&P's perspective, those assets just fundamentally fail the test for something that needs to be absolutely liquid and predictable.
Exactly.
So let's talk about the thinking here, because there has to be a reason Tether is doing this.
Mm-hmm.
Why would you introduce Bitcoin, something that can swing 20% in a week?
Or even a day.
Or a day, right. Or gold, which is an inflation hedge, but is definitely not pegged to the dollar. Why put those in a portfolio whose only job is to stay perfectly pegged to the dollar?
Well, the motivation is all about the risk-return spectrum, right? It's a financial incentive.
Okay.
Short-term T-bills, they're safe, but the returns are low. By putting some money into Bitcoin or gold, Tether is hoping for a much higher potential yield.
So they're chasing returns.
They're looking to capture some upside, either to, strengthen their own capital position or to take it as profit.
So they are literally trading bulletproof stability for the chance at higher profits. And S&P is basically saying that's a trade-off you just can't make.
Not if your product is sold as absolute stability. That is the entire crux of S&P's argument.
Right.
They operate on the standard that these reserve assets have to be immediately liquid. You have to be able to sell them without crashing the price, especially during a market panic when everyone is running for the exits.
And Bitcoin and gold, they just don't pass that stress test.
In S&P's view, no, not even close.
Can you just walk us through how that depegging risk actually works? What's the mechanism S&P is worried about?
Sure. So just imagine a big market crash, a crypto winter like we've seen before. Let's say the price of Bitcoin drops, I don't know, 50% in a week. If Tether is holding a big chunk of Bitcoin in its reserves, the total value of the pool backing that $184 billion of USDT, it just instantly shrinks.
And then if people get scared and start a redemption run,
now you have a huge problem.
They'd be forced to sell those Bitcoin holdings at a massive loss just to give people their dollars back.
Exactly. And the risk gets compounded. First, the asset's value drops. Second, if you try to sell a huge amount of Bitcoin all at once, the act of selling itself pushes the price down even further.
It's a death spiral.
It's a dangerous feedback loop. And S&P is just saying this exposure creates a vulnerability that doesn't need to be there. It's injecting instability into the system.
Okay, so this whole volatile asset piece it's obviously crucial, but it's only half the story, right? It wasn't just what Tether was holding, but also how they were reporting it. So let's shift to the second major factor, the gaps in governance and disclosure.
And this is where the qualitative stuff really hits hard. I mean, the transparency issue with Tether is it's not new. This has been a headache for them for years.
And S&P called it out specifically.
They did. They pointed directly to gaps in disclosures and governance as a major reason for giving them that weakest rating.
When you look at how a credit rating works, I mean, governance is all about trust, isn't it?
It's all about trust.
S&P isn't just looking at a balance sheet. They need to know the processes are solid, that the reports are sound, the communication is clear. So why do they see Tether's governance as so compromised?
Well, it goes back to their history. For years, Tether has faced criticism for giving these attestations instead of full, proper audits.
And there's a big difference.
A huge difference. And while they do their attestations more frequently now, S&P's concern is the lack of detail, the lack of granularity.
So what kind of detail is missing?
For instance, when Tether reports on its other assets, the stuff that isn't T-bills, the reports often lack crucial info, like what's the duration risk, who are the counterparties, what's the actual quality of those other investments.
So S&P can see a line item that says other investments, but they can't actually do their job and figure out the true risk profile of that bucket of assets.
That's it exactly. If the governance is opaque, S&P can't accurately model what happens in a shock. They can't see who Tether might be exposed to or how quickly certain things could be sold.
Which forces them to just assume the worst-case scenario when they're assessing the risk.
You have to. That assumption of worst-case risk flows directly into the lowest stability rating. The opacity itself becomes a threat. It doesn't even matter if the underlying assets are good or bad.
It's the fact that you can't verify it.
That's the problem. For a stablecoin, trust is the entire product. S&P is basically telling the market, we can't do proper due diligence here because the disclosures aren't good enough.
And if the public can't confirm what's in the reserves, the dollar peg is just based on faith.
And faith is a very fragile thing during a market panic.
So this brings up a really crucial point for anyone listening who holds or uses USDT. This downgrade, it's a huge comment on their whole reserve model.
It is.
This practice of mixing super safe assets like cash and T-bills with these higher risk volatile assets like Bitcoin, it just fundamentally changes the risk you're taking on.
It really forces you to reevaluate what stable even means in this context. S&P is challenging the entire model.
They're saying you can't do this.
They're saying you can't diversify into volatile assets, especially when you have transparency issues, and then still claim to have the highest level of stability. They're saying the current structure warrants the weakest possible rating. It makes you ask, should we see USDT as a safe dollar equivalent thing or more like a managed risk fund?
And you have to imagine the regulators are watching this very closely.
Oh, absolutely. For places like the EU with MiCA or the US as they think about stablecoin rules, this S&P downgrade it's a gift.
It's Exhibit A for why they need strict rules.
Exactly. It completely backs up the argument for very restrictive reserve requirements, maybe even banning volatile assets entirely from these systemically important stablecoins. S&P is basically validating the most conservative approach.
So this brings our deep dive to a close, but it feels like the real story, the fallout from this, is just getting started.
Without a doubt, every other stablecoin issuer is watching right now to see how Tether responds to this.
Do they get more transparent? Do they sell the Bitcoin?
And the really provocative thought I think I'd leave you with is this. If the world's biggest stablecoin is actively choosing to get exposure to Bitcoin and gold,
Chasing that yield.
chasing yield or hedging inflation, whatever the reason, does that mean we're seeing a fundamental shift in what we should just expect from the stable currency now?
Yeah.
Or is S&P right? Is this strategy just a guaranteed recipe for a depeg down the road?
It's a huge trade-off.
It is. And it's one you have to weigh every single time you look at a digital asset that claims to be stable. Are you getting a yield or are you getting stability? Because right now, it looks like you can't have both.